Well, good afternoon, everybody. Welcome to our webinar today. My name is Sean van den Berg. I head up client education at PSG Online. Our topic today is understanding fundamental analysis, and we're going to go from 1 o'clock to 2 o'clock. Any questions you guys have, please just type them up in that little box for questions, and I'll try and handle them preferably near the end of the presentation. Just remember, this presentation will be emailed to everybody that's on this webinar today. And we're also recording it, but that will still take a while before that will be sent out. But any questions, please just type it up in the little box on the software, and I can see it, so everybody can also take part in the questions. So let's get started. The agenda for today, I'm going to discuss broadly what is fundamental analysis, and I need to highlight obviously the importance of macro fundamentals, because there's a tie back to the micro fundamentals of financial statements. So we'll go very briefly over financial statements, and I'm going to use the example of Mr. Price, the last interim results as an example. But the main focus will be understanding the financial ratios, and from there looking at two valuation techniques that we at PSG Online incorporate. And then also my main objective is for you to understand how to use the PSG Online research tools, the value filter and the quality filter and things like that. So that is my main focus with today's webinar. Okay, so we're going to get started broadly. We look at share market analysis together. There's three questions you always need to ask yourself. What share must I buy? When must I buy? And when must I sell? Now the question, to answer the question, what must I buy? That is covered with fundamental analysis. So how good will this be? How good will this company be as a future generator of earnings and dividends? So that's broken further into what we call macro fundamentals. That encompasses the economy. How does the company operate within the economy? There are various factors we'll look at. We could call them influences on the economy, and obviously ultimately affects the company. Then we're going to talk more about micro fundamentals, and this pertains to the company itself, obviously the nature of the business, but more specifically the financial statements, because that's what you and I as private investors have access to, is all the financial statements, be it off the company's website, or you ask the company secretary to actually post you the actual, what we call glosses. But on the micro fundamentals, we look at the income statement, the balance sheet, and the cash flow statement. And from there, various financial ratios to help us discover, obviously, the health of the company, but also more importantly, is this a company that's going to grow? Or the earnings going to grow, or the dividends going to grow. Because ultimately the share price should be going up together with the growth. On the other side of the coin, obviously, when to buy and when to sell, that's technical analysis. But our focus today is obviously on the fundamentals. Okay. So I just want to also highlight for you, there's two ways to look at the market, and I suggest you use both. What we call the top-down approach. This is where you look at the big picture that entails what's happening in the economy and the financial world. Obviously, from there, you chunk down a bit further, look at various industry sectors as such. You want to find, obviously, the sectors that are outperforming the market. You want to go with the growth sectors and things like that. Look at our market at the moment, where the commodities and the gold market has been hit recently, because the perception is obviously the economies are slowing down. There's no demand for commodities and things like that. Whereas the financial and industrial shares will be flying. So within those strong sectors that are outperforming, you look at specific companies. So you do further analysis on those companies. And then from there, you're going to choose those companies that you all think will be successful. So the objective is looking at, obviously, geographically. So in today's presentation, we're only going to focus on South Africa, the JSE. But ultimately, as an investor, you want to maybe diversify your portfolio offshore. So obviously, you want to go for the markets that are growing, or the perception of growth as such. And from there, obviously, the industry, and then from there, the size of the companies and things like that. But they say that using the top-down approach is one of the most useful ways of determining the most promising sectors. So users incorporate this in your analysis. By the way, I got this all from the Investopedia website. Okay. The bottom-up approach, and this is what we use on the website a lot, obviously de-emphasizes the significance of the economic and market cycles. So the focus is mainly on the specific company. So instead of looking at the sector now, we're focusing on individual companies. So the main assumption here is we're assuming that the individual companies will do well regardless of what's happening with the sector or the industry. So the main thing here with the bottom-up approach obviously entails a thorough review of the company in question. And that's obviously becoming familiar with the company's products, what does the company do, the nature of the business, the management, etc. So you need to know what's the company, the financial stability of the company. You also get to know the company's financial statements inside out. And as I said just now, that we're going to be focusing on Mr. Price, and obviously we look at the interims. The best source of information is the annual financial results. That gives you much more information about the company's products and services, etc. Okay, so that's just a quick heads up using the two approaches in your analysis of a company. So let's talk about economic analysis quickly. There are 5 influences as such that can affect the economy and obviously ultimately the company itself. Number 1, obviously, is inflation. That's in South Africa. We talk about relative to the Reserve Bank target. They're going to target or the inflation between 3 and 6%. We're at the top of that scale. Obviously, our biggest imports is oil and food and things like that, or grain. So that has a big influence on our markets. And we use interest rates as a mechanism, what they call monetary policy, to control inflation. So interest rates here in South Africa, we're at 30-year lows, and the perception is that they might keep interest rates lower for longer. GDP, the benchmark there is growing more than 4%. We're way below that. You see some pockets of the economy lagging, for example, the mining sector, whereas the manufacturing sector or the services sector might be doing better. At this point in time, we're about 2.6% of GDP. The forecast this year about 2.5%, next year a slightly bit more. So that's also important to take in consideration. If the economy is doing well, most sectors will be doing well and most shares will be doing well. The exchange rate also a big influencer on a company, especially if it imports products or is an exporter. So you need to take that in consideration. Is the rand getting stronger or weaker? Or is it weakening? At the moment, we're hovering around about, what's it, 9.18. Obviously, the exporting shares or companies that have operations offshore will be benefiting from that. But obviously, your cost is still in rands and things like that. Foreign interest rates going up or down. The general consensus is that we are bottomed out. But obviously, the biggest influence here is inflation. And obviously, with quantitative easing and all the stimulus policies out there at the moment, there's more money being pumped into the economies. That will put pressure on the price of goods and services. Obviously, that's inflation. Inflation has to go up sooner or later. So you keep an eye on that. But that all ties back into the stock market. And if you look at this little table here, and by the way, this all comes from a tutorial, online tutorial number 3. I suggest you guys go through it into more detail. But it highlights the relationship between the stock market and all these economic criteria. So if the stock market is above average, let me just bring my little highlight in here. If the market is above average, it means interest rates have been declining. So it's like a seesaw. Interest rates are declining because inflation is coming down. We're trying to stimulate the economy because it's below average. You find that the rand will be strengthening, obviously money coming into the country, also because interest rates, foreign interest rates are declining. And vice versa, you find that the market will be underperforming or under the average performance because interest rates are going up. As I say, the market comes down, interest rates go up like a seesaw. So again, let's go through this very quickly. Go through the online tutorial and goes into more detail. But the best way to explain this is by looking at the investment cycle. So here we got the 3 scenarios where we got the stock market, the stock market growth. This is GDP. We're way below 4% at the moment. This is the average. So we're still going up, and interest rates are bottomed out. So we had to look at 4 different phases. I'm anticipating we're roughly about here. So everybody has to look at this investment cycle and position themselves accordingly, where you think the market is and things like that. So that gives you a rough estimate of the investment cycle. Okay, so that gives you a quick introduction into what we call macroeconomics. Let's start back more specifically to the sector. This is a useful slide to look at. This red line represents GDP growth, economic growth. So as obviously this is contraction as the market falls, and then as it starts picking up, it's expansion. So you want to position yourself in those specific sectors as the economy growing. So as the economy starts picking up now, you should be more focused on the banks and financials. Obviously, people are borrowing more money on credit to expand their businesses and things like that. So you should be more overweight neutral in that sector. As the economy starts growing and growing faster, you should be more overweight, for example, the chemical sector and diversified industrials, etc. Top of the market, obviously hotel and leisures and that kind of stuff. And so it will go down again. Should be less exposed as the economy starts slowing down to beverages and education and those kind of things. So it's a useful slide to position yourself going from the general to Pacific down to Pacific sectors now. Now this is the main objective of today's situation, today's webinar. We're going to focus on company analysis. So after determining that the industry's, the outlook is good for the industry, you're going to analyze and compare the individual company within that sector to its peers. So you use various financial ratios and cash flow values, etc., to help you identify the best company in the most promising industry. So that's our objective today. So we're going to examine past performance and help us project or anticipate future prospects. So the objective is to understand the company and its outlook very, very well. So bottom line, as a fundamental analyst, your goal is to determine what is the true value or the intrinsic value of a share, and compare that value now to the share price, and determine from there is it cheap or expensive. Okay, so that is our main goal as such. Just remember, any questions you guys have, just type it up and I'll try and answer them at the end of the presentation if we have time. Okay. Again, what I suggest you do is go back onto the website. Before you log in, there's a little button here called Resources. You'll find a section there called Tutorials. So click on Tutorials, and as I say, Tutorial 3 and 4. This is what this webinar is based on. So it goes into more detail. Please go through it. It reinforced a lot of the information that you'll be learning about today. Okay. So let's talk about financial statements. The three financial statements we're going to handle very, very briefly is obviously the income statement, the balance sheet, and the cash flow statement. These are the tools that you as an investor use to determine is this a worthwhile prospect to do further analysis or further investigation into. So this is very broadly, the income statement is I call it the movie, the cumulative effect of the last 12 months trading. So imagine a video recording of the company's operations for the last 12 months. That's what we're looking at here. So the income statement, all you're doing is looking at all the expenses subtracted from the income. And my goal as such is to look at profitability. Remember, it's a 12-month period. So I'm looking at profits. Are there any profits after expenses are deducted from income? And obviously, we're looking at future growth. So that's my main objective when I'm looking at the income statement. On the other hand, the balance sheet is a snapshot. Imagine taking a photo of the company's operations a day in time. So it's a position of the financial position at a single point in time. It's usually obviously the company's financial year end, whatever the case might be. There's an accounting equation that we use. It's assets minus liabilities plus shareholders' funds. Okay, that's how the accounting equation would work. So assets, obviously, there are a lot of different things we look at. This is what you use to grow the business, be it land or property or machinery. We can go so far as to we talk about current assets. We talk about stock and debtors and things like that. We'll go into that in more detail just now. Just understand with the balance sheet, what we're trying to work out here is the health of the company. That all depends on the quality of the assets. Okay. The cash flow statement, on the other hand, also looks at the 12-month period. And here we're looking at cash and the cash equivalents moving in and out of the company. So you want to see is where's the money coming from and where has it been spent. You want to see that the company can convert profits into cash. Okay, so those are what we're going to discuss now quickly. So there's a very simplified income statement. Obviously, this will show you 2 years. In this situation, I'm only showing, oops, sorry, let me just go back again. This is only showing you 1 year, and compare 1 year to another year, and obviously you want to calculate the percentage difference. Is it been growth or is it been contraction? So bottom of the top line we're looking at, they call it sales, or sometimes they call it turnover, or sometimes they call it revenue. You'll see just now when we talk about Mr. Price, they refer to revenue and they refer to sales. So top line is the sales we made. Less our cost of sales or expenses. What did it cost us to make those sales? Then we get what we call operating profits, or more commonly referred to now as earnings before interest and tax and depreciation and amortization. Okay, so that's all our operating expenses. Then we get our finance expenses, and if we've got any borrowings, obviously our interest charges, so we have to subtract So that has to be a separate line item. Subtract our finance costs, and from there we get our profit before taxation, or earnings before tax. Then we get our a separate line item again. Remember, the receiver wants his portion of the profits in form of tax, so we have to declare the tax as a separate line item, so as our taxation on profits. Then we get our profits after tax, okay, and then after that, depending on the company's capital structure, when the company first started out, we might have had ordinary shareholders, but we also might have had preference shareholders. Now, a preference shareholder, the big difference between a preference shareholder and an ordinary shareholder is that preference shareholder gets his dividends first. The disadvantage is they have no saying at the AGMs and things like that. So that's a major big difference. So just in case the company has any preference shareholders, we just disclose that we're paying out the preference shareholders first. Okay. Then we get our earnings owed to shareholders or net profit, and then our ordinary dividend. This is you and I as ordinary shareholders. What is our dividend? By the way, most of the shares traded on the market do have ordinary shareholders, ordinary shares, and that's what we focus on. Okay. What's left behind after the ordinary dividends be paid out is what we call retained earnings. Obviously, this is a source of capital that the company can use to expand their business next year, obviously to get rid of debt, whatever the case might be. That's a very simplified income statement. Okay. So as I said, I'm going to be focused on Mr. Price Group. All of us can relate to the company, we've seen it. Those of us that are Shark supporters, we know it's the main sponsor. We also understand that Mr. Price is not only clothing or textiles, there's sport, there's also Mr. Price Home. So it's got 3 different divisions. What I've highlighted here is, this is where I got the information from, these 3 little blocks. So the income statement, they refer to it as a consolidated statement of comprehensive income. So this is the interims. So this is the last 26 weeks up to the 29th of September. The results, by the way, the financials will be due only about the 25th of May. So this is what the numbers we'll be using now in this example. So as I say, with Mr. Price, they've got a top line called revenue. And remember, Mr. Price also might sell, they have started selling stuff on credit now. Obviously, most of the stuff is on cash, but this revenue amount now does include credit sales. What we do at PSG Online, we focus on the retail sales. So in this situation, we're 6 billion. Remember, this is in millions, rand billions. This is 6 billion. Okay. Then going back to our income statement, we might have other income. Now, other income, they have to disclose that this is not part of normal sales. They're not selling any clothing or any home appliance, home thing and things like that. So this is something from, they might have sold something that might have been a property or a building or some kind of stuff. That has to be disclosed as other income. Add those 2 together. This is the income we're working on. Okay, that's 6021. That's where we get this number from. Our cost and sales, what did it cost us to make those sales? Over 5.3 billion. Okay, and that, by the way, is broken down further. There's our cost of sales and our selling expenses. That might be marketing and things like that, and all the other administrative costs. So this is just added up, and that's how we get to this number here. Subtract those 2 numbers together, we have our operating activities, our profit from operating activities. That's how I got to that number. Less our income. So obviously they have more finance income than finance expenses. They actually offset the two together or against each other. So we have a net finance income. Add the 2 together, we have this profit before taxation. There's our taxation, 242 million. So you work that as percentage of your income. That'll give you your tax. Remember, you're trying to get as close as 29% as possible. And then subtract the 2, and that's what we're looking at. That's our profit owed to shareholders. That's a very simplified way of looking at the income statement. From there, we start dividing that by the number of shares in issue, and we start looking at basic earnings and things like that. Okay, so you'll see that they talk about various different earnings. So that's 605 million divided by the number of shares in issue. We have basic, headline, diluted, and we'll go into more detail a bit later. So it's using these numbers now, and we calculate that relative to the share price, current share price. Now we start looking at the earnings yield and the price earnings multiple and things like that. Okay. So that's the income statement. From there, as I said, we'll look at various financial ratios just now. Look at a very simplified balance sheet. Remember, this is a snapshot in time, a photograph in time. Remember the accounting equation. Assets minus liabilities equals our net assets. Where was the money spent on? Okay, In this situation, we're at 200 million in assets, less our liabilities, which is owed to is our creditors, okay? And we have a total net assets of 150 million. Where did the money come from? It came from shareholders' funds. Obviously, this is the initial funds that when they first started the company, plus all accumulative retained earnings over the years. And we spoke about the income statement right at the bottom, retained earnings. So this is where it's transferred from the income statement to the balance sheet. So this is where the funds come from. What did they do with it? Okay. So with Mr. Price, this is looking only on the one side of the equation. We're looking at assets here. And assets is broken into what we call non-current assets. This is longer than 1 year. So that includes property, plant, and equipment. And then intangibles are things like goodwill and patents and things like that. Less long-term receivables, okay? That is long-term receivable with the debtors and things like that. Less any defined benefit. This is obviously the staff pension fund and things like that. And obviously they made allowances now for tax. Remember, that's still income or funds that we use, but it hasn't been paid out yet. So it's still funds that has to be reflected on our balance sheet. So add that all up. That refers to our non-current assets. The current assets is anything that can be liquidated or moved into cash very, very fast. So that's why we call it cash current assets, anything less than 1 year. So that includes inventories. Now, the inventories, remember, will include raw materials, goods being processed at the moment. Remember, Mr. Price will be an importer. He imports a lot of goods from overseas. So when we talk about inventories, this will be the stock and things like that. Trade and other receivables, this will, as I say, will be the debtors and things like that. And then we talk about cash. This will be the cash in the tills and obviously the money in the banks. Add that all up together. That's how we get this current assets. So add the non-current assets plus the current assets. That's how we get our total assets. Remember, that's on one side of the equation. Remember the balance sheet. It has to balance. So where did the funds come from? So let's look at the equity and liabilities. So we've got equity and owed to shareholders. Remember, this is retained earnings from previous years and initial capital with the company started with. In this situation, 2.8 billion. That's where the funds came from. And then we also got 199 million from non-current liabilities and 1.2 billion from current liabilities. Main thing is obviously things like creditors. We've got our trade and other payables. This is obviously we've imported these goods. We've got creditors that we buy it from. That's what we're talking about here. Also, we refer to lease obligations, all these different Mr. Price homes and Mr. Price sports, various lease agreements to be paid, and this is what we're making allowances for. Okay. Anyway, bottom line, add those all together. That's how we get our total equity and liabilities. So 4.2 billion in liabilities has to balance with our assets. So that's looking at the balance sheet. And as I say, from there, we can start looking at the health of the company. Okay, and that's how we calculate things like the net asset value. We'll get back to it a bit later. The third document we want to look at is what we talk about is the cash flow statement. There's three parts to it. We focus on the section called operating activities. Now, what's important is the bottom line here. Net cash provided by operating activities. In this situation, we're talking about 58 million compared to 44 million the previous year. Now, you want to take this number now and compare it to the the earnings per share value. So you take it millions and break it down to per share value. So you would also look at sustainability. Now, we'll talk about sustainability in more detail a bit later. But what you want to do in this situation, subtract depreciation. So there's our depreciation from this 58 million. So on the next slide, you'll see what I'm talking about. At 58 million, our net cash provided from operating activities, minus our depreciation. Remember, we're looking at sustainability. We have adjusted cash provided by operating activities of 44 million. Okay, take that number divided by the number of shares in issue. Okay, and that's how we got this cash flow per share value, 5.18. Okay, take that number relative to the divided by the headlines earnings per share or earnings per share value. We got a 7.4 value. Sorry, a ratio of 0.69. Now, what's important is compare 1 year to the previous period. You can see the previous year we had 0.5, now we got 0.9. Anything above 0.75 is considered very good. In other words, You're looking at converting 75% of your profits into cash. That's what you're looking for. On the other hand, if you find a company consistently has a ratio of below 0.5, you should question that. A little red flash should go up, a little warning. Okay, whoa, this company is not converting its profits into cash. Something must be wrong. Okay, so now we're starting to talk about financial ratios. So this is one of the first things I always look at from a cash flow point of view. Those of you that have your own business, we always talk about cash flow being king. Cash is king. So this is important, looking at financial risk. So let's talk about financial ratios. This is what the income statement looks like. As I said, there's 3 parts to it. We want to focus this number here. Take that number, remember that's in millions, divide by the number of shares in issue, compare that now to the earnings per share. And that's when we can talk about a ratio. By the way, remember, all this homework is done for you on the PHL website. We look at the current financials, we break these numbers down for you. So that's what I want to highlight, how to use the tools on the website. So on our website, once you've logged in your username and password, go click, first step, you go click on the little button called Share Info, and from there enter the share code. Obviously Mr. Price's share code is Mr. Price, NPC. This will open what we call the Share Info page. Everything related to Mr. Price is one page. This is a section you want to concentrate on. There's a little tab called Research. Click on the Research tab, and then from there click on Company Analysis. Now we have a company that works with us called IFR, Independent Fundamental Research. They look at the financials, exactly what you're doing. So obviously this is all based on the last interims. However, since then, they have released a trading statement, and they're anticipating that the earnings were increasing by 20%. So based on the interims, you'll see we're talking about the PEG ratio. It was expensive. It was when the share price was at 141. Okay, the PEG ratio was at 162. We actually had a sell recommendation on Mr. Price at that point in time. All of us that were involved with retailers know that the retailers did come off big time. So based on the last trading statement, this was on the 10th of April, the share price was obviously much lower. We're talking about 115. That's why we gave it a hold recommendation. But let's talk about these financials in more detail. So based on our criteria, you can see our HEPS growth and things like that. We'll go into more detail just now. This is the numbers that you're going to look at. Help you determine, is a share worthwhile looking into? Is the share undervalued, profitable, is got manageable risk and things like that? So we look at quality ratings, we look at valuations and things like that. So as I say, this is on the interims. Mr. Price at that point in time was expensive. Obviously the share price did fall back a bit, but this was based at 141 Rand a share. It did pull back to 115 Rand a share. So it obviously became a bit cheaper. And as I say, I'll explain all these big ratios to you now. So let's talk about these financial ratios. There are at least 20 financial ratios you can calculate using the financial statements we spoke about. I'm just going to highlight about 5 or 6 of them for you. But bottom line, if I had a magic wand, I'm looking at 3 things. I'm looking for shares that are undervalued, profitable, with manageable risk. So your benchmarks and such, the average of the market now is on PE of about 16. We're talking about a PE now. But the PEG, this is what we prefer to use, is a PEG, is a PE relative to its growth. So we're looking at shares that have this, what we call margin of safety. So any shares that are trading below 75%, that's what we're looking for. Alternatively, you can also use the price NAV ratio. Anything in our benchmark, there's anything we're looking at below 2. When we look at profitability, we look at operating margins. We also look at what is called return on equity, and our benchmark is 15% plus. When it comes to risk management, we talk about cash flow. You can look at the debt equity ratio. We prefer to look at what we call interest cover. This also highlights, for example, a financial risk. Anything less than 3 times, especially for a large cap stock, you'd be worried. So even a mid cap stock, you might go for, or a small cap stock, rather go for 5 times cover. So I'll go through all these little ratios very quickly for you. So first of all, you want to buy into a company that is profitable. So you're looking for companies that are making pies. Remember, in other words, instead of using profits in the market, we talk about earnings. Remember, only a portion of profit gets paid out in the form of dividends, and that's dependent on the company's dividend policy decided by the company's directors. What's left behind is what we call retained earnings. But let's take that profit now. In this situation, we call it earnings divided by the number of shares in issue. What we're trying to calculate is what we call earnings per share. You're going to break it down to per share value. What is each profit per share? So in our example here, we've got 66 million divided by 825 million shares in issue. In this example, our earnings per share value is 8 cents per share. take that number now compared to the current share price, now we start looking at various financial ratios. So let's talk about what we call an earnings yield. So it's the current earnings divided by the current share price. As I say, it's what we call an earnings yield. You want to compare the share, and obviously the share against the sector, but also you can compare it loosely to the return you can get in the banks. In this example, 8 cents divided by the current share price of 1 rand or 100 cents, our earnings yield is 8%. Now, if the banks are giving you 10%, obviously this is not a good investment. So you want a high earnings yield when you're looking at that column in the newspaper. Compare one share to another share, high earnings yield. Remember, compared to the return you can get in the banks. Now, the inverse of that, what we call a price earnings multiple or price earnings ratio. So our current share price is 1 rand divided by the current earnings is 8 cents. In this situation, the price earnings multiple is 12.5 times. So you can look at this loosely as, what would I prefer? To take 10 years to recover my money at the market or 5 years to recover my money at the market? So you obviously want a lower price earnings multiple. But saying that, by the way, also, sorry, I forgot to mention this one. The dividends is calculated exactly the same way as earnings. The amount of dividends being paid out, in this situation, 3 cents out of our 8 cents. So our dividend yield is 3%. The average of the market is between 2.5% and 3%. So you want a high dividend yield. So going back to our example of Mr. Price, those different descriptions of earnings. They got 4 different examples. The ideal situation to use would be what they call diluted headline earnings per share. We're talking about, explain these things in more detail. Diluted is after all new issues or anything has been converted from convertible debentures, whatever the case might be. So you want to look at the worst case scenario price. Okay. So diluted headline earnings would have been the ideal situation to use. However, they don't describe or don't display how many shares were diluted as such. So in our example with Mr. Price, we used the headline earnings per share. So basic earnings is the company's profit allocated to each of its shares. Okay, remember it's the profit owed to ordinary shareholders divided by the weighted number of shares in issue. So obviously if the company issued some shares 9 months into the year, we average it out. That's what we talk about weighted. Here in South Africa, we use what we call headline earnings per share. Going back to our income statement, remember we spoke on Mr. Price, he had that other item, other income. So whatever you do is you bring that back. Okay, in the income statement, we subtract it to calculate headline earnings per share. We bring it back in. So bottom line is we have to confirm that it's a once-off item. You can only sell the property once, but the main idea with headlines earnings per share gives us a better idea of sustainable earnings. And this is what we focus on at PSG Online. We're looking at sustainable earnings. Okay. Now, if the company does issue more shares during the year or the company buys back its shares, this is where we talk about dilution. Okay. So bottom line, you want to focus on, as I say, the worst case scenario price. So if the numbers were available, you would use the diluted headlines in per share. Again, back to our example. Now, I want to try and tie this back to what you see in the newspaper or what you see on our website. Mr. Price, remember we want to calculate what they call a rolling PE. Now, Mr. Price, for last year, whole of last year, they had earnings per share of 503 cents per share. Okay, you can break it down further. The first 6 months of the year, what they call the interims, by the way, being a retailer, the working weeks, so the first 26 weeks, they had interims of 187.3 cents per share as in earnings per share. His final 315. So obviously, the second part of the year contributes more to their profits. Combine the two together, we're at 503. Now, the example we're looking at now is the last interims to September 2012. Okay, so you have to subtract this 253 from that. That's how we get this here. So you add the two together, not subtract. We add the two together, and this gives us a more realistic value to work on. Okay, this is how we calculate a rolling PE. You know, compare one number to another number. So in this situation, to calculate the price earnings multiple, the PE ratio, the share price, this is based on yesterday's close, was 123.08, and our last earnings we had calculated this from that there was 568.9. So divide that, and that's how we get a current PE. So look at yesterday's newspaper, you'll see that the JSE had a PE ratio for Mr. Price of 21.6. Okay, and that also ties back to on our website. Okay, what does that mean? Is it cheap or expensive? So if you look at the overall market right now, this is looking at the PE ratio for the whole market. When the market's trading around about the 17, 18, we're expensive. And when we're trading at 8, we are cheap. Okay, so that's based on the whole market, looking at all the PE ratios of the market. Mr. Price as such, we're hovering around about 21. Now, if the market is at 17, 18, you can understand that Mr. Price is expensive. But that goes for all the retailers. Okay, they're not cheap right now. They have pulled back. You can see this little movement here from 141 way back to 180, 115, but they're still not cheap. Okay, so when we look at the PE ratio, this is the most common way of looking at determining if the share is overvalued or undervalued. But now let's talk about undervalued specifically. What does undervalued means? Undervalued means it's trading at below its true value. Now, what is true value? That's the big question. So most analysts would recommend undervalued shares, obviously with a strong buy rating. Now, we at PSG Online, we prefer to use a thing called a PEG ratio. And I'll explain how we get that just now. Now, historically, high PE ratios are typically growth stocks. Now, a lot of people shy away from them. I said just now you want to go for shares with a low PE multiple. So they're not necessarily overpriced or not necessarily ignored as a long-term investment. For example, Avang right now is trading on a PE of 19, but it's still considered cheap. How do I say that? You have to bring into the other side of the equation is the growth. Okay, remember the PE ratio, looking at the current share price. And that PE ratio, by the way, is calculating its earnings over the last 12 months, as we saw now with Mr. Price. That doesn't give you a true reflection of the growth potential. So you want to look at the relationship between the PE ratio and its projected growth. Now, then, as such, as I say, it's growing by 28. Now, that is still much higher than your PE of 19. And that's how we bring into the PEG ratio. It counts for that growth. So let's talk about the PEG ratio. So it's fast becoming the most frequently used valuation technique. The PEG ratio, as I say, the PE relative to its growth, PE ratio divided by the forecast average growth over the next 5 years. So our focus is not only selecting companies on a low PE ratio, but looking for companies that have a PE ratio that's low relative to its earnings growth. So we're targeting better companies on low PE ratios. So as long as the earnings growth is higher than the PE ratio at the time of investing, that's the kind of thing you're looking at. However, saying that, just be aware that the PEG ratio does not work very well with companies that have volatile earnings. So, for example, obviously the mining sector and resources and things like that are volatile. So be careful of that, number one. Number two, be careful of companies of declining profitability and low growth rates. And so it's all very well going for companies that are undervalued, okay, but you also have to look at the quality. And we'll talk about that just now. Also, the quality of the shares are important. So that's just a quick introduction to the PEG value. Here we've got two shares, both trading on a PE of 15. Which one do you go for? You want to go for the companies with higher growth. Okay. Now this situation, the stock one, by the way, this company is growing, its share price is at 1 rand, other was at 2 rand. This company is growing at 30%. So divide the 15 by the 30. That's how we get a PEG ratio of 15%, which is considered cheap. The other share, stock 2, also has a PEG of 15, but it's growing its earnings by 10%. Now the PEG ratio in that situation would be 150, which is considered very, very expensive. The sector as such, 75% will still be considered cheap. Here's an example of two companies. Remember, we want to go for companies that are trading on a PEG of close to 1. Okay, that will be fair value. Okay, the company's growing its PE of 30 and a growth of 30%. That's how we get a PE or PEG ratio of 1. So ideally, anything below that will be considered cheap, anything above that will be considered expensive. So it's a trade-off between cost and growth. So here we've got an example of an IT company and a beer company. Most people will go for IT companies that anticipate higher growth and they're willing to pay up a higher PE. They're willing to wait 50 years to recover the current earnings. But the PEG ratio will tell us this share is expensive, okay, and the share price has overextended itself. Whereas a beer company will be still considered cheap. So if you compare the two together, I'd rather go for a company that has a lower PEG ratio. On our website, by the way, it's all color-coded for you. Most of the shares in the market right now will be considered fair value. They are trading between 76% and 125. Anything above that, 125 plus, will be considered overvalued. That's what you saw on Mr. Price just now. We want to focus on the shares that are undervalued, between 35 and 75 on the peg. Okay. So that's one way of looking at valuation. Let's look at NAV. NAV, bottom line, is the ordinary shareholders' funds divided by the number of shares in issue. In this situation, it's 276 divided by 850. We got a net asset value of 32.4 cents. Compared to that, to the current share price of R1. In this situation, our price NAV is 3.1 times. Okay, people are willing to pay up 3.1 times higher than its NAV. By the way, I forgot to mention what is NAV. If the company had to go into liquidation, so we sell off all our assets, pay off all our creditors, what's left behind is what we call NAV. This, together with return on equity calculation, are the two most powerful tools to use together to help you determine if the share is cheap or expensive. Okay, so in our example, obviously 3.1 times, that's very high. Our benchmark is closer to 1. Remember, if we're trading at 1, we're trading at NAV. We're trading at 0.9, we're trading at a discount to NAV. So you're trying to find shares that are trading at a discount. Most shares should not be trading below that, but those are the kind of shares you're looking for. You're looking for shares trading at a discount. So that's looking at NAV and valuation. Remember, that ties very closely together what we call return on equity. You want to see sustainability. So you want to see that growth rate can be sustained. So people are willing to pay for that growth being reflected in the share price based on their assets. This is one way of calculating it. Profits owed to shareholders divided by shareholders' funds. Okay. In this situation, we've got a return on equity of 23.9%. Okay. That's one way of calculating it. Alternatively, headline earnings per share divided by opening NAV. In this situation, you have to go and do some homework for yourself. But bottom line, the numbers are very, very similar. Remember our benchmark, more than 15% plus. Does the share meet my criteria? Yes. Okay, so you dig a bit further into the company. Remember, the higher the return on equity, the more it justifies a higher price NAV. Okay. Let's look at risk. We talk about debt equity ratio. What part of debt, which part of the business is financed from debt? This will be our long-term and short-term interest-bearing debt. There's our cash in the banks divided by the shareholders' funds. In this situation, we've got 144 million in debt and 288 million from shareholders' funds. So we've got a debt equity ratio of 50-50. Is that good or bad? What's important is it manageable? Can we pay the debt back? That's why we prefer to look at interest cover. We've got our earnings, our profit, divided by our net interest. So obviously we've got interest being received and interest being paid out. In this situation, we've got 150 million rand in profits, and our interest bill is 20 million. How many times can we pay the interest bill out of earnings? In this situation, 5.75 times. Now, when it comes to financial risk, remember, you're going from cash into shares. You want to be able to manage that risk to a certain extent. So you're not buying into a company that's got a good chance of going to liquidation, okay, going bankrupt and such. So our criteria is 3 times cover. As long as the company can pay its interest out of profits 3 times, or it's covered 3 times, we say it's manageable. In this situation, 5 times by far meets our criteria. Less than 3 times, don't waste your time, okay, analyzing this company. It's a risk, so rather look into something else. So this gives you a quick overview of some of the financial ratios. Remember, going into more detail on the tutorial, but this quick overview. Remember the big picture, macroeconomics is important to see how the economy is doing. Obviously, that will be reflected in the industry and the sectors as such. The 2 most important things to look at is inflation and interest rates. Okay. When we look about various benchmarks, remember the bottom-up approach. We're talking about HEPS and turnover growth more than inflation. We conservatively work on 10% plus. Profitability, we look at return on equity, risk. We look at its cover, cash flow, as long as it's more than 0.75, ideally. And you want to look at the growth from one year to the next year. And evaluation, the 2 methods that we look at, what we prefer to look at is price, NAV, and PEG. So those are benchmarks to help you get started. Those help you filter through the shares and help you focus on the better opportunities in the market. But saying that, we're talking about filters. Let's talk about the research tools available on our website. There's a thing called Value Filter. By the way, where would you find it? You'll click on Research, and then there's a little button here called Filters. Now, let's say, for example, we've been looking at Mr. Price. Mr. Price is in the sector called general retailers. So you can see if I click on that little select from the drop-down list, general retailers, and click on go, you can compare it to all the other general retailers, compared to Truworths and Fushini's and things like that. You can see most of these shares, going back to our legend here, are fairly valued. Okay, there are one or two shares that are actually overvalued. For example, Massmart, okay, and Taste Holdings. Now remember, Taste Holdings is mainly Scooter's Pizza and things like that, but they also have the NWJ, the jurors in the business. Okay, there's only one share out of all of them that's undervalued, Mr. Lewis, and that's what we highlighted last week in our investor, those of you who subscribe to our newsletter. So out of all the retailers, most of them are expensive or fairly valued. But how do you know you're focusing on the right sector? So what I suggest you do is rather go click on search, research, and then the search button. And there's a little button here called undervalued quality shares. Click on the default. It will spit out a list of shares for you that are based on the value investor that are undervalued. From there, you can do further analysis. Click on the share code and go to the share info page. But this is a big time saver to help you filter the market. What's important, same list now, is go click on the quality tab. So it's only while looking at shares that are undervalued, what you also want to look at is the quality. So all these different financial ratios, by the way, there's more than 12 of them, we actually give them different ratings. So you want to focus on companies that have a quality rating more than 70%. Okay, less than that, obviously you're not looking at companies that are consistent with their earnings and things like that. That brings in inconsistencies, which is uncertainties, which makes it a bit more difficult to analyze a company. So the tools available on our website, big time saver. This helps you focus on potential winners, and from there you can chunk a bit deeper. Remember, click on the share codes. We take it ultimately through to the company analysis. Maybe you want to tie it back to your analysis. You want to create a watch list of potential potential winners as such. So the watch list is also a very useful tool. So you want to build up a watch list. Ideal situation always, I like to look at 3 scenarios where you have financial shares, some industrial shares, and your mining resources. The website allows you to create those 3 different watch lists. So the watch list puts you in the starting blocks. It highlights obviously the price activity first of all. What's more important, once you've created your watch list, is click on this little button here called View as Investor. It changes your watch list now to the value investor. From there I can click on each different column, and from there highlight which shares offer the better opportunity, especially looking for shares to buy into right now. So you can see some of my shares, my watch list, are undervalued, some of them are more fairly valued. So it's a bit of a blend between value stocks and growth stocks. So this is from this watch list, you'll be able to choose some shares now for be it the simulator or be it the shares for your investment portfolio. So it's that blend between value and growth. So this is just a quick heads up to help you use the tools on the website but understand the financial ratios behind the tools. Okay. So talking about tools, I do write a weekly or bi-monthly newsletter called The Investor. Last week we wrote about Lewis. So I only take 1 share per every 2 weeks, as I say, it's bi-monthly. We'll highlight the positives and negatives of that company. Our objective is a 3-year view. So we're looking at the company in 3 years' time, at least making 50% compounded. So roughly about 15% per annum compounded, give us more than 50% in 3 years' time. So I'll just send this newsletter out to everybody. As long as you have an active account with PSG, a fully funded equity account, I'll gladly send this to you. So the focus is more for the long-term equity investor. Those of you that are short-term traders obviously have different newsletters for that. But this is just tying back to our module on our webinar on fundamental analysis. This is a different tool, highlights opportunities for you in the market, maybe to also compare to your analysis and things like that. So a quick summary before we get into the questions as such. Please, I know you guys are going to come back to your questions as such. How do I tie the stuff on the financials on the website, on the company's website to PSG's? Just understand that PSG adjusts the figures for sustainable growth. So yes, we only concentrate on continuing operations, but also we look at adjusting the figures to help us determine operating margins and all those kind of things, return on equity. Remember, we adjust for sustainability. Okay, so before I get on to questions. Use the tools on our website, especially the watch lists. As I say, it suggests to break it down further. Remember, top 40, mid caps, and then small caps. So there's more than 400 stocks on the market. You want to focus on the watch list, allow you to look at the maximum of about 90 shares. I suggest you fine-tune it further by creating 3 different watch lists based on financials and resources, financials and industrials. So remember, it does 2 things. Obviously, highlights price activity and also highlights the view as investor. And use those tools, the value filters, to help you find opportunities for the watch list. Okay. So before getting into the questions, just a heads up quickly. Our traders forums, this is face-to-face meetings we have around the country. We just had one now in Durban. Our next one now will be next month here in Joburg. That will be the Tuesday, the 28th of May. Members from 6 o'clock to 8 o'clock. This is where you can meet me and we can talk about the market. But the main idea there, we're highlighting trading and investment opportunities. Pretoria, I'm there in end of June. We're back here in July, and then I'm in Cape Town end of August. So those are just the next traders forums coming up in the next few months as such. Our next webinars coming up on the 15th of May. I've had quite a few requests regarding the basics. So it's an introduction to the share market. So this is not for everybody. It's more for the novice investor or trader. What is a share? Why do we have a share market? What's my rights as a shareholder? And things like that. And then going forward, at the end of the month, we talk about point-figure charting. A lot of people have forgotten about point-figure charting. Very powerful analysis tool to use for noughts and crosses. I use it for price projection and things like that. And then going forward, we talk about value investing and growth investing. That'll be June. And then bringing back to more the traders, derivatives. So it'll be end of June. Currency futures, July. And then more technical analysis, more advanced technical analysis explained. We talk about Elliott wave, cycle analysis, and things like that. So that's until the end of July, and I'll be posting up more until the end of the year. But please remember, these things are booked. They get booked very quickly. They are limited to the top 100 people. Go to the website right now and go book a seat. Okay. So remember, just in conclusion, this presentation will be emailed out to everybody, hopefully either today, late afternoon, or tomorrow. Remember, use the website tools and refer to the tutorial, especially tutorial 3 and 4 on the website. And remember, subscribe to our long-term investor as an additional tool. And then, as I say, watch out for our upcoming webinars and things like that. Okay. So let's tackle the questions or see what questions are out there at the moment. If I don't answer it here, remember, I can always follow up with you guys. It's quite a few companies. Why is companies not calculated for NASPAS? Is it because of volatile earnings? It could be that we're expecting the results. Frankie, this is a question from you. Doesn't make NASPAS expensive. Remember, NASPAS is mainly Tencent Holdings, obviously Hong Kong and things like that. So you'll find the companies like Richemont and breweries that have extensive offshore operations will have a very high PEG ratio, and you'll think that's overvalued. But just remember, if you're looking at interest and things like that, the environment they're operating is slightly different compared to South Africa, where interest is much higher. So sometimes they might be skewed. Offhand, I'll have to find out why NASPAS hasn't got anything. I don't have those figures right with me right now, Frankie, so I'll get back to you afterwards. Okay. But just be aware of that, that obviously companies like the Richemonts and the breweries and the NASPAS might have higher PEG ratios. It doesn't mean there's something wrong with the company. Just remember that, Marius, you asked me a question here regarding sorry, read something can be wrong when not succeed in converting profits to cash. Like what? Company. Okay. This is the cash flow. So this is Marius' question regarding converting cash to profits to cash. So if you see a company's got consistently as a cash to earnings ratio below 50%, something will be wrong. But also remember that it could also be a timing issue. So the company might not have cash now because they just maybe have bought a lot of stuff offshore. They went and imported a lot of products. So remember, dig a bit deeper and find out why. But if it's consistently below 50%, that would be alarm bells. So I hope that answers your question, Marius. Fraud, talking about, it's just that, as I say, it could be that the directors of the companies might be misappropriating funds instead of converting profits to cash. They might be buying Porsches. That's the main thing I want to be watching out. I don't see any other questions coming through. But I suggest you guys, as I say, go read through the online material, goes into more detail regarding the cash flow. So that'll answer your question more, the calculation and the things to watch out for. Main thing is looking for is consistency. That brings in what they call the margin of safety. If you had to look at what they call margin of safety, it's just looking at consistency. So, guys, I hope this presentation helped you. It was beneficial. I enjoyed presenting it. From my side, thanks for your time. And as I say, I'll be sending this presentation out this afternoon. Please go through it. Any questions you have, here is my email address, and here's my contact number. So I'm not an expert on fundamentals. My background is more technical analysis, but I've learned over the years fundamentals and technicals together are important. But I hope it was beneficial and you found it useful. So the presentation is being recorded, but I'll be sending the presentation, the PowerPoint presentation out to you guys. Thanks for your time, and we talk again. Enjoy your day. Bye-bye.